advice which goes to the current generation is to have a second income.
How can they smartly use the credit cards without falling into the debt trap?
This has to be done only by asset allocation. So basically an aggression, while that aggression happens, the aggression takes you two ways. One is up and one is down, and both can be to the extremes, right? When you need X amount of money at that point of time for a particular goal and your money is down by, say 30-40%, I call that particular instance as a disaster.
Hi, good morning, sir. Today, I'm going to ask you a few set of questions that is most asked by the Gen Z. So, getting started, the first question that I would ask you is, as of now, most of the Gen Z would be starting their job. Many of them are the freshers now. So, in the next 5 years, how can they maximize their earning potential if they start from today?
Okay. So the first thing which they have to do, if they have to maximize their wealth or earning potential is, let's talk about creating finances, a good corpus. Then the best thing or the first thing they have to do is start investing early. And because they are young, they can mostly be into equity oriented investments, which is primarily, it should be more of equity mutual funds, and because it's a monthly salary and they probably may get a lump sum here and there, but it is predominantly monthly salary. So the monthly salary, the convenient way to invest is through a SIP in an equity mutual fund. They can also buy stocks on a month basis. So the moment they get their first salary credit, they should start this investment. So this grows to a substantial amount whenever they stop work after 20-25 years. This can grow into a big corpus. So it's about starting early. Then the next thing is widely the advice which goes to the current generation is to have a second income if possible, right? If there can be a subtle second income which can be a pilot which can run of its own, it's on an autopilot mode, probably they should look for that also, because if there is some uncertainty in their core job, which is their primary income earning stream, the secondary one, the subtle one, probably can give some cushion at some point of time, and the secondary income which comes should go completely into investment, because I'm sure all of them, particularly given their high starting salaries which the current generation has, that should be more than sufficient to take care of their needs today. The second income stream should go completely into invest. One. Next is, which I think most Gen Zs today follow, is, the moment they think there is growth stagnation in the current place where they work, right? We are talking mostly about the salary, because most individuals are salary. So whenever they see a stagnation of growth in terms of the position, learning, and also income, they consciously take a call to move out. That should be taken, and that review of whether I am growing enough in terms of learning, in terms of growth, in terms of positions, in terms of satisfaction, and in terms of monetary growth. They should constantly check this, and if this is not happening, then they have to make a move. Normally a move in job comes with a 20-30% hike. This also ensures that the growth in income also can land up into growth in investment. So this also gives a good substantial growth. Then there are a lot of people after 5 years, 10 years want to become entrepreneurs. So these people, at least for the first 3 years, the moment they become an entrepreneur, they should do a calculation of what is the running expenses for their family for the first 3 years. That should be ready as savings. Without that, if they get into a business where the first 2 years or 3 years can be so uncertain, then they will hit the wall in terms of the finance. So these are things they have to take care. And if this discipline is followed, there is absolutely no challenge in terms of a wealth creation and enhancement in finances.
Okay. And also, along with starting your career, many of them will be offered credit cards, which has several benefits in it. But how can they smartly use the credit cards without falling into the debt trap?
See, that's a very big trap which most people fall into. One is, a credit card cannot make you spend more. That should be the first rule. You should have absolutely no motivation to spend more, because there is a credit card which is available, which gives you more potential, it is giving you more money available in your hands, though it's not in your bank account. It is extra money available to use. But don't consider that money. That should not give you any scope or any motivation to spend more. That's the first rule. The reason why I say this is, you may otherwise do a purchase of clothing for 5,000 rupees. That's because a credit card is there, you may do it for 10,000. So maybe if it was 5,000, you might be within the budget. And if it is 10,000, you may be out of the budget. So the first discipline which we say to be followed in credit card is to pay it fully. Not pay the minimum, which is 5%, but pay the 100% before the due date every month. That helps to increase your CIBIL ratings, and that also ensures that you don't fall into a debt trap. Now, if that has to be ensured, the first one has to be ensured. The moment you go overboard, you will go out of budget, out of your income, then you are definitely leading to a situation where you may not be able to pay full, right? This is the minimum rule they have to follow. And if there can be various ways of managing a credit card, using for fuel, using for paying your electricity bill, these kind of expenses, probably you can pay it through a credit card, but you should see to that the money which you would have otherwise spent on this from your bank account is not spent for something else, which is luxury and which is unwanted. It should not be spent for some other want. It should be there in your bank account. Just because you may get that extra points in a credit card, to use that, use the credit card, but let the money be there. Because next month you have to pay this.
That was well said, sir. Now, going forward, there are a lot of people who trade and invest on their own. Just because they are young, they will be willing to take higher risk for higher returns. So, how do they balance aggressive investment while maintaining financial security?
This has to be done only by asset allocation. So basically, an aggression, while that aggression happens, the aggression takes you two ways. One is up and one is down. And both can be to the extremes, right? The upward extreme keeps you happy. The downward extreme puts you into disaster. If that has not to put you into a disaster, there should be a cushion there which will tell you, yes, it is down today and I am not dependent on this for my day-to-day living or for any of the goals, financial goals which I have to ensure it is paid for in the next couple of years. I'm not dependent on this. For that, I have to keep some safe money. It can be in your liquid fund, in a short-term fund, right? Ideally that, not in a bank account. So maybe you can keep 2-3 months money in a bank account. At the most, that even if it's better to be in a liquid fund, because liquid, you also have the option in a liquid fund to be instantly withdrawn on the same day. That options are there. And there you make 5-6% of annualized return. And that is the case. Keep that cushion money, which means, let me put it this way, even somebody is young, the 30% has to be in some safe avenue, right? Some 30. When I say this, we presume a scenario where the person is not going to have any drop in income. Income continues. He has put everything into aggressive investments. But if there can be a financial goal which may come, everybody has financial goals, short, small and big at various junctures. That may come, and there may be unforeseen expenses also which may come. For all this, you keep a cushion of at least 20-30% in safe avenues. Play with the 70%. And how much has to be in the safe avenue is based on how soon your next goals are coming. Right? The moment you have many goals coming in, then you have to start taking from the growth and moving to that safe bucket. Your aggression can be only with the money which can afford aggression. And what cannot afford aggression is the money which has to be spent on something which is coming soon. So if you do this, then there is comfort, there is stability, and you don't have to be worried about the volatilities in the market. When we talk about volatilities, we are talking about equity market. But that said, when I say disasters are a temporary emotion which they have to face, because as long as the investments were in the right funds and right stocks, it's for sure that they're going to come back. But it lands into a disaster when you need X amount of money at that point of time for a particular goal, and your money is down by, say 30-40%. I call that particular instance as a disaster. It's not a permanent long-term disaster.
All right. And also, I see a lot of people taking debt to finance their investment. So my question is, how can someone smartly take a debt to finance their investment without over leveraging it?
See, in general, it's not advised to borrow and invest in general. So rather than even trying to advise how you can borrow and still don't over leverage, the first advice is don't borrow and invest. Okay. Why I say this? Today, if you borrow, the minimum rates which you get from for borrowing is definitely at least a percentage more than what an FD can offer. Means if you are borrowing and investing, the ideal scenario is you make much higher returns than your borrowing rate, but there is no risk of downside in that. And there is no such investment which exists. Okay. The only investment which cannot degrow is an FD or any fixed income, which is a bond. We talk about, because bond also can have capital loss, right? Only the coupon is assured, but the capital loss is still possible. FD is where your capital is the same, you have growth, you don't have degrowth. And even that will offer you at least 1%, 1.5% lesser than your borrowing rate. So that's not advisable. And what can give you more? Equity-oriented investments. Equity-oriented investments, there is a downside. And the downside can be much lower, and it can go much lower than your borrowing rate. So there also it is ruled out. So as there is no investment today which can grow more than your borrowing rate and cannot come lesser than your borrowing rate. So it's because of this, very simple, it's better not to borrow. Yes, if you are working for a large company, there are banks probably, in many cases it is mostly banks. If your bank offers you, at a 3% rate or a 4% rate, these are happening at a 4% rate, and you have a 5 years tenor, 6 years tenor to pay. Maybe there you can look at something like a hybrid fund, a conservative hybrid fund, and invest, right? Because it is borrowed, right? You probably can have some kind of an aggression, but not fully aggressive. So a hybrid kind of investment, still you can look at if this is the rate. But don't forget, by doing that, you are telling yourself the next 7 years I'm going to be bound to stay in this organization. You are chaining yourself to the organization by doing that. Because these things, mostly what happens is, this rate is applicable when you continue. If not, you have to go pro rata, and you should settle at the market rate than what was prevailing. So, though I said the other option, I will still discourage that, because you are kind of becoming the slave of the job for at least next 7th year, or the slave of the organization. So that is also not a advisable scenario.
So, since there is like a lot of uncertainty, as you mentioned, and as of now, lot of us are experiencing this economic downturn. So, how can we manage our portfolios better to address inflation and economic downturn?
See, economic downturns will impact markets in the short term and medium term. We are again talking about Gen Zs. Throughout, we are talking about Gen Zs. So, economic downturns and geopolitical tensions and political reasons locally, some industry specific reasons locally, all this impact overall the market or the specific sector based on the situation. This is possible, and these are downsides which are possible. So it is because equity has uncertainties, it is bound to have higher returns. If it did not have uncertainty, any product which doesn't have uncertainty cannot offer you a higher rate. Logically cannot, right? So only if I'm giving certain examples, right? So if I'm a company, I am borrowing debt, right? So I'm giving bonds, at a certain rate, and I'm borrowing from the public for various reasons of the needs of the company, right? If my company has more uncertainties, the buyer of the bond definitely does that due diligence. When he knows this company has higher potential of higher chances of uncertainties which can hit the company, he expects you to pay more. When the buyer knows this is a very stable company, I don't see any problem at all, he is okay to settle for a lower rate. So I said the logic, if your uncertainties are low, your returns are going to be low. But in equity, all these uncertainties, as long as you have chosen a good fund or a good stock, are temporary. As I said earlier, for all your financial goals, whenever your financial goals are expected, 1.5 to 2 years before that, liquidate and keep that money aside. So that normally, why we say this is, normally bear phases have not lasted for more than 1.5 to 2 years, right? Then probably the recovery may take some time, but the bear phases normally don't last for more than that period. The probability is very, very low. Because of that, if there is a goal coming in, 1.5 to 2 years before that, liquidate and invest. So that whatever uncertainty happen during that time, your financial goals are already taken care, and your mostly, I presume, Gen Z are continuing to do the monthly investment route, which is an SIP route. So in a bad market, you also happen to invest at low prices. You get the advantages. Don't worry about what's happening to your existing investment. Existing investment has nothing to be worried, because your exit year is not today. You are going to harvest or reap only at 55 or 50. Whatever market levels prevail then only matters to you. What prevails today doesn't matter. And if you have invested for a 25 year, even if you are in a downturn in your 25th year, it's almost certain that your returns will be upwards of 12% CAGR, even after that funk. So nothing to be perturbed about what's happened in the interim, and takes these measures of safeguarding for the financial goals which are forthcoming, and then you are still okay to continue with these uncertainties in the market, because these are temporary.
Okay. Thank you so much for addressing all the questions with utmost clarity. I hope this will be beneficial for all of them. Thank you so much.
Thank you. And it was great, having these questions from your Gen Z's point of view. And these were also interesting questions. I'm sure these are in most of their minds also. Hope this is used to them and they watch many of our most videos so that, they are benefited by the advice which comes into them.
Thank you.